next guest on the show is special. It's Rupal Bhansali, and she's author of a book which we'll just talk about. But before that, Rupal, thanks so much for taking out time for us, coming and talking to us about your book. But before we just talk about your book, two things I want to focus on. One is what would be trends and themes in 2023 for market that you would look at, and secondly, what would you make of all the noise coming in from various central bankers across the world?
So I think the market is obviously very focused on the Fed dot plot and rate changes. I think they're missing the point. It's not about rate change, it's about regime change. And the regime change is moving from a world of QE to a world of QT, quantitative easing to tightening. And the implication of that is, in a world of QE, risk-taking was rewarded. And so equities and other asset classes did extremely well. In a world of QT, risk-taking gets penalized. So this requires a very wholesale change in portfolio positioning. And I think defense will be people's best offense in the market environment ahead. So I'm quite bearish on the outlook for 2023. I think that 2022, the correction started, but it has not ended. And frankly, if you look at the last bubble correction, which was in 2000-2002, when the NASDAQ corrected 78% over that 3-year period, there were 7 20% plus market rallies. So I think the most recent rally that we've had is more akin to a bear market rally because of very negative technical positioning. I am not convinced that it's fast. So instead of buying the dip, people might consider selling the rip. That's the change.
Wow, so that's interesting. Defense is your best offense. It's going to be a bit more bearish in 2023, but you talked about how portfolio positioning has to change. Talk to us about how you are looking at the entire EM world. How does India stack up?
So I'm actually generally more positive on emerging markets after being negative for almost a decade. So this is quite a change of point of view, I would say, in the last couple of quarters. But within emerging markets, my preference is much more for markets outside of Asia, in particular Latin America, Brazil and Peru, etc. But also to a certain extent China, which of course is in Asia because China has its own trajectory. It has actually not gone up at all, unlike the rest of the world markets. And sadly, I'm not that bullish on India because I think the valuations remain quite rich. And frankly, the two richest markets in the world, based on the assessment we've done, around the world, I look at least about 30, 40 countries. The US and India are two of the more expensive markets. And usually when valuations are this high, it's actually a setup for poor returns going forward. So I would actually position in the areas of the market which are actually out of favor, and I would say Latin America is prime among them.
Right. When we just talk about valuations and how you look at it, what is the sense that you get? I mean, it's not always about non-consensus investment. It's also about, going with the flow. Don't you think there are a lot of changes that have happened in India which deserve this valuation?
So that is the narrative, of course, and clearly, look, India is actually the darling of US investors. I mean, I'm based in America, I can tell you, I talk to a lot of CIOs because it's a democracy, because it's English speaking, there's a very broad and deep capital markets. And there's a lot of things, going for India, no question. In particular, as you pointed out, Pankaj, after a long time, the Modi government, has made a lot of long-term investments, especially in infrastructure. And that is going to turbocharge, this sort of gross fixed investment, which has been lacking in the country. So I'm not denying that incrementally a lot of positive things have happened. But you see, the challenge with investing is if everybody knows the information, it's already in the price. And so my point of view is that I want to go where the risk is priced in, but the reward is not. And unfortunately in India, the reward is priced in, but the risk is not. So that is why I'm more bearish.
But Rupal, that's exactly the point that you drive home in your book as well, non-consensus investing. Could you explain to us why one should go, against the wave per se, and what are the benefits of, let's say, doing the non-consensus investing? What's the case you're making?
You're absolutely right. Look, being contrarian for the sake of it is absolutely not what I would argue. That can be very dangerous.
Yeah.
And just being alone and losing money is no fun. So it's not about just being non-consensus. But the reason I gave the title of my book, Non-Consensus Investing, is people don't realize. You see, in most things in life, if you're correct, that's more than enough. If you're a student, you give the right answer to the exam, you're done. If you're a lawyer, you quote the right precedent, you won the case. So being correct is enough in most things we do in life. But in investing, it is not enough. Let's say I think that Reliance is going to report 100 rupees of earnings, and then Reliance actually reports that 100 rupees of earnings. I am correct. But if my correct view was consensus, it's already in the price. So there is no money to be made by simply being correct. Not only do you have to be correct, your correct view needs to prove everybody else's view incorrect. So in the sense that your correct view has to be non-consensus, that's when you make a lot of money. So I think people forget this very basic attribute of investing. It's not enough to be correct. And that's what I wanted to highlight.
Right, that's correct. But generally people understand that non-consensus investment is associated to something which is falling and you should buy. So can you just clarify that's not the case? And it may be actually something which is going up and where EPS estimates are lower is what you're asking to buy.
Exactly, absolutely. For example, one of my largest holdings in the US is Microsoft. I don't believe in buying distressed equities. I think sometimes contrarians, people think, just buy what nobody else wants to touch.
Right.
I don't believe in buying junk at clearance prices. I want to own quality when it goes on sale. And so there are lots of those sorts of opportunities. Ultimately, investing is about investing with a margin of safety, which means that the downside is limited and the upside is large. And the way you can get both low downside and high upside, which is very difficult to get in investing, right? I'm talking about having low risk and high return, but that's exactly what I want to achieve. You do that by looking in places where nobody else is looking or looking at it in a way that nobody else is looking. So I'll give you an example. COVID, very few people understand the long-term effects of COVID are actually going to prove very beneficial to emerging markets. Now people say, okay, how is that? Like, what is the connection of that, right? I mean, it's a very non-consensus. I don't think you heard that in the mainstream.
Yes.
But think about it. What COVID has done is fundamentally around the world made remote working acceptable business practice. I think that's without a shadow of doubt, that's accepted.
Agreed.
So before, when you wanted to work for a company, you had to be physically located close to it, right? So which means when I went to America in 1991, I needed a visa, I had to leave my country, my cuisine, my culture, my friends, my family, and I had to go physically. Well, now you don't have to. You can be in your country and you can do remote work. Now think about the problem that the developed markets are facing. There's a major labor shortage. So in the last 30, 40 years, China was the biggest beneficiary when manufacturing hollowed out and blue-collar work got outsourced to low-cost countries. Now, because of COVID, white-collar work will go offshore. And India showed the way, blazed the trail with the sunrise industry of IT 30 years ago. The same will happen in other white-collar work. So long-term, I'm very bullish on emerging markets because these trends are actually not being perceived by investors. And if there's a way to participate in that, I would. But I just wanted to give you an idea that you cannot...
Yeah,
yes.
I also just wanted to understand, when you said about non-consensus investing, you would want to buy quality stocks.
Yes.
Generally quality stocks are associated where EPS growth is, pretty strong.
Yes.
How would you look at FANG? I mean, 2010 to 2020, that was the story. How would you look at those names which are, just trying to acquire sales or trying to acquire market share? How could you do non-consensus investing in over there? They have really corrected. How do you find quality within those names?
Well, first of all, if I could explain all this in an interview, I would have done that and not written a book. So if you want the long form version, read the book on non-consensus investing because I show exactly how to find quality that others have not discovered as quality so that it's not in the price, right? That is the genius of, stock picking, that you find it ahead of the rest of the pack. But to give you a quick answer to that, if you take the tire industry, right? Very few people think of tire industry as a high quality industry. But if you look at Michelin, which is a French tire company, they still manufacture in France, they still manufacture in high cost countries, and yet they make a lot of money. Why do they do that? Because the specification of the tire is very high. And if you go to electric vehicles, you make twice the profit margin that you do in regular gasoline combustion because the battery makes the car heavy. The heavier the car, the higher the spec of the tire. Now that is the kind of research we do to understand what is going to happen in the future. You look at the design wins. Who is taking market share in electric vehicles in the new models? It's only Michelin and Bridgestone. It is not some low-cost country. It is not some third world country. It is not Hankook tire. It is not. So these are the kinds of lead indicators that we can sense as to where is quality and growth, not in the price. And the profit mix, is going to shift, right? Because if for the same unit, you're getting twice the profit margin, your profits are going to grow at a faster rate than sales. Commodity boom going on in the world. Commodity tires, because, trucks ply the tires from the mines, which are very far away to the railroads, the ports. They are actually 2x the profit margin potentially. So people don't see the tire industry as being a vicarious way to play the commodity boom. So it's not in the price. So I'm giving you examples of how you can identify high quality companies. Now, Michelin stock is trading under 10 times earnings, gives me a 3.5% dividend yield, strong balance sheet. Agreed, it is steady growth, not heady growth, but that's good enough.
Sure, I think for the long format, we will have to read that book. So thank you so much, Rupal, for joining us in the studio. Appreciate you being here for us.
Thanks for having me.
Thank you.